They also go by many other different names: financial advisor, fund manager, insurance salesman. However, what is common across all of them is that they make money off of other people's money, whether it's through managing their investments or selling them fancy financial products. It's a big and quite a lucrative business. And I'm here to tell you, I really don't like them.
I can't stand you being here!
Hi, if you're new to the channel, my name is Tay from Financial Tortoise, a channel dedicated to helping the standard generation master money and achieve financial security. If you're just getting started in investing, you really have two options. One is you can pick your own investments. However, if this feels too overwhelming, there is a second option: to get professional help and find a good investment advisor who will manage your investments for you. This makes sense, right? When we're sick, we go see a doctor. When our car breaks down, we find a reliable mechanic. So finding a reliable investment advisor sounds like a sensible choice when it comes to growing our investments. However, I want to tell you to think twice before handing over your money to these so-called professionals. Contrary to what the media tries to make us believe, most investment or financial advisors don't get better results in the market. And unfortunate to many common investors who feel investing is too complicated. It's only made complicated by the financial industry, who spend billions of dollars in ads to make it seem more complicated than it needs to be. So in this video, I want to share with you, 1, why I personally don't like investment advisors, and 2, to convince you that there is a better way to manage your money. First, in order to help you understand why I don't like investment advisors, let's start out with how they make their money. If you can follow the money, you can understand the real motives behind people's behaviors.
Follow the money.
There are 3 most common ways that investment and financial advisors make money. First way is based on commission. The advisor makes money every time you either buy or sell an investment. The fancy financial term for these commissions is called loads. It pretty much works the same way as how car salespeople make their money. Salespeople at the car dealership make a commission on each car they sell. Sometimes, because the dealership is trying to offload certain vehicles quickly, these cars might have higher commission rate compared to other vehicles on the lot. You can guess which cars these salespeople will try to push to you when you're shopping for a new car, right? The one with the highest commission. In the same way, this commission model in the investment advisor world is one of the primary reasons why I don't like investment advisors. There is a blatant conflict of interest here. Most often, you're going to an investment advisor so he or she can advise you on the best investment to grow your net worth based upon your life stage, risk tolerance, and goals. You're trusting that the advisor has your best interest at heart. Instead, an investment advisor who is paid via commission will push funds that have the highest commission rate. Thankfully, Vanguard, my favorite investment firm, does not charge load or commission on their funds. However, there are many funds that do, and you want to stay clear of them as far as possible. The highest commission-based investments are insurance investments. This is the reason why you might have seen insurance products like annuities or universal insurance is advertised or recommended so often by insurance salespeople. They make a lot of money for them, but most often at a high cost to you. I have a whole video about choosing the right insurance for the standard generation if you want to check that out here. If someone really wants to help you grow and secure your investments, a commission-based model is in complete contradiction to his or her goal. There's just too much temptation to push products with high loads versus investment with no loads. The second most common way investment advisors make money is via charging a flat management fee over the investment he or she is managing. Given the abuse that commission model encourages, this sounds like a better option, right? The investment advisors make money by charging a fee, let's say 1 to 2% of the client's total asset under management. He or she is making money on the transaction. The investment advisor is looking out for your best interest because for the fee charged, he or she is responsible for that fund's future, right? But before you think this is a better money-making alternative that makes investment advisors look better, I also have a few things to say about this. With the AUM model, the investment advisor isn't making money based on the actual performance of the fund, rather the size of the fund. Since he or she is charging a management fee to manage this fund, the bigger the fund, the more money he or she will make. It doesn't matter if the fund is doing better or worse than the market. The advisor will still make money nonetheless. And this can bleed into investing advice as well. Let's say you have $50,000 and you're debating the choice between paying off your outstanding debt or giving it to your investment advisor to invest in his or her fund. What do you think the advisor will say? Though paying off your outstanding debt might be a better personal finance decision for your family, the advisor will advise that you invest that fund in his latest fund. Why? Not because he or she will make more money for you, but because it will make more money for him or her. And that's not the worst of it. The 1 to 2% management fee is absurd compared to what you can get with a low-cost index fund like VTSAX. VTSAX, my personal favorite index investment vehicle, has an expense ratio of 0.04%, and the industry average for passive index fund is about 0.2%. These fees, when compounded over decades, can have a devastating effect on your portfolio. And this is if the returns on the fund can match the market. Most actively managed funds underperform the market. Investment managers may not be looking out for your best financial interest, but you can by downloading my free PDF personal finance guide. Go to my website at financialtortoise.com and download your free copy of Sandwich Generation's Guide to Financial Security, 10 Steps to Securing Your Family's Financial Future. I also have a link in the description below. Given that the second most common way investment advisors make money doesn't make them look any more favorable, let's see if the third time's the charm. The third model of how investment advisors make money is via fee-only or hourly fee model. Essentially, the investment advisors only make money for the time that he or she is advising you on your investments. There is no commission or asset fee model to tempt the investment advisor. The advisor is strictly paid on his or her advice of where, what, and how to invest your money, based upon your life stage, risk tolerance, and financial goals. If there's one way you want to use an investment advisor, this should be the only way. However, as you can guess, many advisors don't like this model because it limits their opportunities to make money. And given it's not as stealthy as the commission or asset model, clients can be harder to work with. When we see actual money going out of our checking accounts, we tend to demand more service. Thus, it's no surprise that many advisors tend to dislike this model. The bottom line is this: vast majority of money being made in the investment advisory industry is made via commissions and asset management models. As I stated earlier, this by design pins the advisor and the client's interests in opposition to each other. How many advisors do you think will intentionally ignore selling high commission or fee investment products to their clients because it doesn't best align with the client's investment goals? Whether we like to believe it or not, we all act in our own best interest. And this is especially true in the money management world. Some may argue that despite the high commission or the fee that comes with these investments, they have a greater performance and they're actually best serving their clients. However, these are far and few in between. And as a general rule, if an investment is expensive to buy and own, they are really good investments. Stay away as far as you can. As I mentioned earlier in the video, when it comes to investing, you really have two options. You can choose your own investments, or you can choose an advisor to manage your investments for you. Regardless of what you choose, both options will require some work from you: research, vetting, and validation. I can tell you honestly from my personal experience that the first option will pay greater dividends for you in the long run. Not only will you get better returns, but you'll also gain the confidence that you can manage your own investments yourself. Investing doesn't have to be complex. If someone tells you that it is, they likely have other incentives. Increase your financial knowledge and ignore the investment advisors that try to sell you fancy financial products. No one cares about your money more than you do. And by increasing your financial education through videos like this, you can soon learn to manage your investment yourself with far less cost and much better results. If you want a good starting place for your investment, check out my video here on 5 best Vanguard funds to buy and hold forever. Until next time, thank you for watching and take care.